Imagine a computer so powerful it could crack the security of billions of dollars in just minutes.
Oh.
It sounds like the setup for a heist movie.
It really does.
But this is the computational reality we are actually facing. We're seeing the dawn of quantum computing and advanced artificial intelligence happening at the same time. And for the world's leading cryptocurrency, Bitcoin, this isn't some distant theoretical risk anymore. It's a critical challenge, both for the near term and the long term, and it's forcing a really rapid evolution in how we think about cryptography and digital security.
That's absolutely right. I mean, for over a decade, Bitcoin's entire foundation has rested on these mathematical principles that classical computers they simply can't solve them efficiently.
Right.
But the convergence of these two technological titans, AI and quantum, it fundamentally rewrites the rules of computation. And if you rewrite those rules, you rewrite the rules of digital trust and financial security.
So today, we're embarking on a deep dive into this really complex interplay between Bitcoin, AI, and quantum computing. We're going to dissect the specific threats that are lurking, not just in hardware advances, but in the underlying math itself. We'll explore the dual-use nature of AI, seeing it as both, a devastating market weapon and a crucial network shield.
A weapon and a shield. It's the perfect way to put it.
And finally, we'll examine the critical, maybe even painful adaptation strategies that are already underway, both across the globe and within the crypto community itself.
And we've built a pretty substantial stack of sources to guide this deep dive. Our insights pull crucial context from major market analysts, specifically Galaxy Digital, who give us a great look at how all this impacts investor sentiment and market maturity.
Okay.
We're also leveraging cutting-edge regulatory insights from bodies like the National Institute of Standards and Technology, or NIST. They're the ones leading the global migration to what's called post-quantum cryptography.
Which we'll definitely go into.
Oh, absolutely. And finally, we've got rigorous academic research focusing on digital security, disinformation, and, the cryptographic fundamentals of Bitcoin's key architecture.
Our mission here is to take all this incredibly dense, highly technical information, from the esoterics of elliptic curve mathematics to these global black box dilemmas, and just synthesize it into clear, actionable knowledge.
Right.
We want you to feel equipped, not overwhelmed, so you can understand what this technological convergence means for the future of digital assets and decentralized finance.
Okay, let's unpack this.
Let's do it.
So when we talk about the quantum threat to Bitcoin, we have to start at the very bedrock of its security. The elliptic curve and digital signature algorithm, or ECDSA. What is ECDSA actually doing in the background every time a user moves Bitcoin?
Well, you can think of ECDSA as the engine of authority in the Bitcoin network. It performs two absolutely vital functions. First, it generates your unique key pair. You have your public key that everyone sees on the blockchain, and then the private key that absolutely must remain secret.
And the second function? The second is that it creates the digital signature for every single transaction. It's the part that proves to the entire network that the person spending the money is actually authorized to do so because they're using their private key.
And the entire cryptographic foundation of this system, this whole house of cards, rests on a mathematical riddle known as the elliptic curve discrete logarithm problem, or ECDLP.
That's the core security model. It's all based on a concept that mathematicians call a one-way function.
Okay, a one-way function.
Yeah, think of it like a mathematical path that is super easy to travel in one direction, but virtually impossible to reverse. So a user starts with a large, randomly selected integer, which is their private key. Let's just call it D.
Okay.
They perform a complex operation multiplying D by a known generator point, which we'll call G, on this thing called an elliptic curve. And the result of that is their public key, which we'll call Q.
So private key D times G equals public key Q. And the public key Q is visible to the entire world. But the magic trick here is that using classical computing power, you can't efficiently calculate that secret starting number, D, just by looking at the result, Q.
Exactly. The difficulty of that inversion of finding D from Q is what we call computationally intractable.
Intractable.
Yeah. For classical computers, trying to solve that problem for Bitcoin's standard 256-bit system would literally take billions of years. We're talking far longer than the predicted lifespan of the universe. That's the inversion barrier that's protecting every Bitcoin holder today.
The invention of the quantum computer means that barrier is, well, about to be utterly dismantled. And this is where Shor's algorithm comes in, offering what you'd call an exponential compromise.
Shor's algorithm is the quantum weapon that's pointed directly at all public key cryptography, and that includes ECDSA. It uses the principles of quantum mechanics, specifically superposition and entanglement, to perform calculations in a way classical computers just physically cannot.
So it's not just a faster brute force attack.
No, not at all. Instead of brute forcing the problem, it effectively solves the underlying mathematical structure of the ECDLP by finding something called the period of a modular exponential function. And that drastically reduces the computational steps required.
And that distinction, an exponential speedup versus a classical sort of polynomial speedup, is the difference between billions of years and, well, potentially just hours.
That is the scale of the change we're talking about. When we look at the hardware required, we're talking about a computer capable of executing Shor's algorithm stably. To break the 256-bit elliptic curve system that Bitcoin uses, a quantum computer would need around 2,330 logical qubits.
Okay, now we hear a lot about major tech companies announcing these really high numbers of physical qubits. Why is the distinction you just made between physical and logical qubits so vital here?
It's absolutely crucial because physical qubits are inherently noisy. They're prone to error, interference from the environment.
Right.
They're just unstable. A logical qubit is an error-corrected, stable computational unit. To get just one stable logical qubit, you might need hundreds or even thousands of these noisy physical qubits, all working together for redundancy and error correction.
So even if a company says they have a 1,000 qubit machine, they're talking about physical qubits, not the stable, logical ones needed for this kind of attack.
Precisely. And while we are rapidly approaching that 1,000 physical qubit mark today, achieving 2,330 stable logical qubits, that's still considered a challenge for the early 2030s. This is why the threat is looming, but it's not immediate.
Right. And here's where it gets, for me, really interesting. Because if and when we do achieve that 2,330 logical qubit threshold, the theoretical attack time is just shockingly short.
It is. Based on one set of estimates from 2019, which calculated the computational cost, a system like that could theoretically crack a 256-bit key in as little as 10.5 hours.
10.5 hours.
Yeah, think about that. A security model that relies on eternal intractability suddenly becomes solvable within a single workday.
Now, this is where the panic can set in. But we have to clarify Bitcoin's vulnerability window. Not all Bitcoin is immediately at risk. Why is that distinction so important for anyone listening who holds Bitcoin?
It's vital because the quantum attacker needs one key piece of information to launch Shor's algorithm against your private key. And that's your public key, the key we talked about.
Okay.
When you create a brand new Bitcoin address and you haven't spent from it yet, only the hash of your public key is revealed on the blockchain. Without the full public key, the attacker can't even start Shor's algorithm.
So when does that public key become public and therefore vulnerable?
The public key is revealed to the entire world the moment you spend coins from that address. It has to be, because the public key is required to verify the digital signature that authorizes the transaction.
This is a crucial design element, but it's what opens that vulnerability window.
And based on current analysis, how much Bitcoin is just sitting out there in addresses where the public key has already been exposed? The numbers are pretty significant. Right now, around 1/3 of the total Bitcoin supply, that's approximately 6.7 million tokens, is held in addresses whose public keys are already public.
1/3 of the supply.
Yeah. This includes a lot of older legacy addresses, particularly those that follow the older pay-to-public key hash standard, or P2PKH. This 6.7 million token supply is the segment that's most immediately susceptible to a quantum attack on the ECDSA private key. It's the low-hanging, incredibly valuable fruit for a quantum adversary.
Before we move on from the quantum threat, let's just make sure our listeners understand that Bitcoin's entire security model isn't equally vulnerable. The consensus mechanism, proof of work, which relies on the SHA-256 hashing function, is actually far more resilient.
That's a critical contrast to make. Proof of work uses SHA-256 to secure the blocks. Now, while quantum computers can speed up hash brute forcing using a different tool called Grover's algorithm, the speed up isn't exponential like it is with Shor's, it's only quadratic.
So what does that mean in practical terms?
It means it offers a security reduction, effectively halving the key length, but it doesn't break the system instantly. It just makes it a bit easier, but not easy enough to be a practical threat.
Meaning the computational resources required for a successful attack on the consensus mechanism, on the mining process, remain astronomical.
Precisely. To break the 256-bit hashing system using Grover's algorithm, current estimates show it would still take an estimated 1.8 times 10 to the power of 4 years.
So 18,000 years.
Right. So the threat to the overall mining process and consensus is very resilient against current projected quantum timelines. The vulnerability is highly, highly specific. It's the ECDSA signature that authorizes the transaction, not the SHA-256 hashing that secures the chain.
Okay, that sets the stage perfectly for the mathematical threat. But now we have to turn to the second major challenge. If quantum is this slow-burn existential threat on the mathematical horizon, AI is the immediate agile dual-use threat operating right here, right now, across the markets and the information sphere. AI is often presented as either a savior or a destroyer in the digital asset space, but the reality is that it's both at the same time. And its threat vector speed and opacity is fundamentally different from that mathematical threat posed by quantum computing. Let's start with the dark side, algorithmic manipulation.
The consensus among researchers is pretty clear. AI introduces systemic threats that are too fast to stop and too opaque to understand into our financial systems.
Too fast to stop and too opaque to understand.
Exactly. This means manipulation is no longer a human endeavor, carried out by phone calls or slow trades. It's an algorithmic process that is faster, more scalable, and just exponentially more effective.
So we're moving beyond the kind of traditional insider trading or pump and dump schemes. This is coordinated chaos, driven by autonomous algorithms capable of instant reaction.
Absolutely. And the key tool here is what's being called the financial deepfake. AI enables the rapid and cheap generation of incredibly convincing manipulated media images, video, audio, text that is often impossible for human investors to distinguish from authentic content.
And the goal isn't just to trick one person.
No, the goal is to systematically erode confidence in the integrity of the marketplace itself. It's about creating chaos and distrust on a massive scale.
And we have concrete examples of this happening in real time, destabilizing massive exchanges in minutes.
We do. The Pentagon deepfake incident showed the sheer power of instantaneous disinformation. A single fake image of an explosion at the Pentagon generated using AI was rapidly circulated, and it led to $500 billion in stock market losses within minutes.
$500 billion.
Gone in minutes before the truth could even be confirmed. This is what AI-driven speed looks like when it's deployed maliciously.
And this rapid spread is powered by autonomous bots that coordinate this disinformation at a scale we've never seen before.
These AI-powered bot networks use real-time analytics to scan market trends and social media sentiment. They identify the optimal angles for exploitation, maybe during a period of high political tension like an election or a natural disaster, and then they instantly adapt and propagate false narratives for maximum virality.
It's terrifyingly efficient.
It is. We already know that falsehoods spread about 70% more quickly than the truth on social networks. AI supercharges that dynamic. It creates a constant, overwhelming supply of misleading content.
This speed and autonomy also create a massive regulatory problem, this black box challenge. I mean, traditional securities laws were designed to police human actors, people who have a discernible bad intention.
And that's the legislative nightmare. When an algorithm operates as a black box, making complex, lightning-fast, autonomous decisions that destabilize markets, it's incredibly difficult to find a human responsible or to apply existing legal frameworks.
There's no mens rea, no guilty mind to prosecute.
Exactly. The autonomous system acts without a legally recognizable, culpable mental state, and legislative bodies, which are constrained by slow processes, are just consistently outpaced by the innovation itself. This regulatory lag allows these threats to multiply completely unchecked.
Okay, that paints a pretty grim picture for market integrity. But let's shift to the defense side of the coin. If AI creates these systemic threats, it must also be essential for systemic defense. How is AI being harnessed right now to defend decentralized networks like Bitcoin?
Well, AI is essential for enhancing security and, just as crucially, efficiency within blockchain environments. The most immediate and widely deployed defensive application is advanced anomaly detection.
And how does anomaly detection work on a vast open ledger like a blockchain, which has millions of transactions happening every day?
AI algorithms excel at pattern recognition in massive data sets, so they ingest vast streams of historical transaction data to establish baselines of what constitutes normal network behavior.
So things like the typical size of transactions, the flow between addresses, the time of day, that sort of thing.
Exactly. And when a transaction or a series of transactions deviate significantly from this established norm, say a sudden massive transfer from a wallet that's been dormant for years, or a repeated pattern of small, high-frequency malicious transactions, the AI rapidly flags it as an anomaly.
This sounds pretty similar to systems used in traditional finance, but it's being applied to the decentralized world.
It is. Major companies like MasterCard already use similar machine learning systems to analyze trillions of transactions in real time. Applying this to a blockchain enhances data integrity. It ensures the accuracy and consistency of the ledger, making it much more difficult for malicious activity, whether that's from a quantum attack or just a simple scam to slip through unnoticed.
And beyond pure security, AI is also being explored to actually make the underlying blockchain protocols run better and more sustainably. This is the optimization angle, which is particularly important for proof-of-work systems.
Right. This moves beyond simple fraud detection and into enhancing the core efficiency of the network itself. Machine learning can be integrated directly into consensus mechanisms to optimize processes.
How would that work in proof-of-work, for example?
Well, machine learning can analyze network congestion and mining pool behavior to predict bottlenecks and optimize resource allocation. The goal is to maximize throughput and, very importantly, reduce the energy consumption inherent in proof of work by making the entire mining process more computationally efficient.
So AI could actually help address the major scalability and sustainability challenges that have always plagued these early blockchain designs without requiring the community to constantly debate hard-coded parameter changes.
Exactly. It uses data to dynamically manage the system. And if you look even further into the future, you see some really radical concepts emerging, particularly in the realm of governance. Some projects are envisioning entirely autonomous governance models.
And that's where AI meets the Decentralized Autonomous Organization, or DAO. What does an AI-powered DAO even look like in practice?
The concept involves using AI systems to automate critical consensus decisions that are currently made by, human voting or complex on-chain processes. These AI systems would make decisions like adjusting fee structures, implementing protocol upgrades, or even managing treasury assets based solely on data-driven objective insights.
So the aim is to get unparalleled efficiency and resilience by just removing human bias.
And reducing the speed limitations that often plague decentralized decision-making. It's the ultimate evolution of decentralization, a network governing itself based on unhackable math and objective data.
But that introduces a new form of the black box problem, doesn't it? If the governance system itself is an AI, how do we ensure transparency and trust in its decisions?
That is the core challenge. We have to balance the clear benefits of AI efficiency with the foundational principles of decentralization and transparency. If the AI becomes too complex, or if its decision-making process is entirely opaque, it risks becoming a new centralized point of failure.
A single, powerful black box that no one truly understands or can audit.
Exactly. The focus has to be on developing auditable, explainable AI, or XAI, for these decentralized systems.
That's a profound thought. Now that we've established the theoretical quantum threat and this immediate AI challenge, let's try to ground this convergence in a couple of specific real-world stories that illustrate the high stakes of adaptation and trust.
Good idea.
Our first story brings us back to that immediate kinetic threat of AI-driven market mayhem. We mentioned the $500 billion loss triggered by the Pentagon deepfake, but let's talk about the psychological and informational chaos this is causing.
The Pentagon incident wasn't just a technical glitch. It was a profound attack on investor confidence. A single fake image was deployed, and because of the speed of algorithmic trading and social media propagation, it created instantaneous, widespread financial destabilization.
It proved that AI could manipulate the market at speeds that human reaction and human regulators simply cannot match.
Exactly. And this isn't an isolated incident. Academic benchmarks confirm that synthetic threats are growing systemically, and they're eroding trust across the entire financial system.
What kind of numbers are we seeing?
Well, we've seen a massive surge in synthetic identity fraud, which contributed to an estimated $35 billion in losses in 2023 alone.
$35 billion.
And moreover, the scale of disinformation production is just breathtaking. We've witnessed a tenfold increase in AI-generated fake news sites in just 1 year. Over 1,200 such sites were being actively tracked by early 2024, This deluge of what's called generative text oversupply makes it incredibly difficult for investors to discern reality from fiction.
A tenfold increase in fake news sites in just 12 months.
Yeah.
That represents a fundamental systemic shift in the cost and ease of generating propaganda. It makes the urgency for defense both technical and cognitive paramount.
It really underscores that the defense strategy for digital assets has to be twofold. You have to secure the underlying code, and you have to fortify the human critical thinking required to navigate the information landscape.
But the crypto community is being proactive. Our second story highlights adaptation strategies and quantum hedges that are already being deployed. Let's look at Zcash's architectural solution to this.
Zcash offers a really compelling preemptive measure against the quantum threat. They utilize something called shielded pools, which leverage zero-knowledge proofs.
Okay, what do those do?
Essentially, these proofs allow a user to mathematically verify that a transaction is valid and that they own the funds, all without revealing the public key associated with the token stored in that pool.
So if Shor's algorithm requires the public key to exist openly on the ledger to break the private key, Zcash just removes that vulnerable data point entirely.
Exactly. Tokens stored in these shielded pools are effectively quantum-proof today, not because they're using post-quantum cryptography, but because their design philosophy inherently obscures the required input for the quantum attack. It demonstrates how alternative blockchain designs can offer robust, built-in protection against the specific mechanism of Shor's algorithm.
Meanwhile, the global regulatory apparatus is tackling the broad replacement of classical cryptography. This is that massive post-quantum cryptography, or PQC, transition being driven by NIST.
Right. NIST has been running a multi-year, highly complex standardization project to find cryptographic algorithms that are quantum-resistant. They recently finalized new quantum-resistant lattice-based standards, including FIPS 203, 204, and 205. This is a global defensive effort driven by the need to protect against what they call harvested data.
The harvest now, decrypt later threat. That's what's truly driving the urgency for encryption migration across governments and major institutions, right?
Correct. Governments and major corporations are assuming that sophisticated adversaries are currently collecting massive quantities of encrypted data. Everything from intellectual property to personal data, which is unreadable today.
But the fear is that once a large-scale quantum computer is viable, maybe in the 2030s,
they could retroactively decrypt all of that harvested data. That possibility demands immediate migration for all encryption protocols.
However, migrating Bitcoin to these new PQC standards isn't just a simple software patch. The engineering hurdles are significant, maybe even painful, because the math underlying PQC is fundamentally different from ECDSA.
This is probably the most challenging engineering hurdle they face. The new PQC signature schemes, like the lattice-based MLDSA, they are not designed to be small and efficient like elliptic curves were.
Why not?
To achieve quantum security, they require larger mathematical structures, specifically large vectors and matrices. This necessity translates into signatures that are significantly larger. We're talking up to 40 to 70 times bigger than the current ECDSA signatures.
40 to 70 times bigger. That number is shocking. I mean, Bitcoin blocks are already capacity constrained. Isn't adopting these massive new signatures functionally equivalent to severely damaging the network's efficiency and scalability?
That's exactly the core of the capacity dilemma. We're moving from the mathematical elegance of elliptic curves to this lattice-based cryptography, which trades off that small size and efficiency we love for quantum resilience.
And this size increase poses major challenges.
For three reasons, really. First, how many transactions can you even fit into a single block? Second, the increased bandwidth required for nodes to transmit those massive transactions. And third, the cumulative size of the immutable ledger, which affects the storage requirements for anyone wanting to run a full node.
So if the transaction size increases by up to 70 times, the community faces this painful choice. Do they accept drastically reduced transaction throughput and skyrocketing fees, or do they significantly increase the block size?
And it's a choice that's fraught with governance history. I mean, increasing the block size breaks with years of carefully managed scalability debates, and it dramatically increases the hardware barrier for running a full node.
Which pushes towards centralization.
Exactly. Higher node requirements push towards centralization, which is antithetical to Bitcoin's core value proposition. This technical trade-off forces a major philosophical governance debate.
And the problem is compounded by the fact that even if the community achieves consensus on a PQC standard and a hard fork, They still need to coordinate the migration of those 6.7 million vulnerable Bitcoins.
The sheer volume of vulnerable tokens needing to move strains the network to its breaking point. Current estimates suggest that if every holder of an exposed address were to move just a nominal value of Bitcoin, say, $100 worth to a new quantum-proof address,
Just to secure their funds.
the migration process could consume the network's entire capacity for anywhere between 10 to 30 months. And that's assuming this migration is prioritized over all other uses.
10 to 30 months of essentially dedicated network time just to clean up the keys that have been exposed over the last decade. That insight highlights not just a technical challenge, but an unprecedented coordination challenge for a decentralized global community.
The challenge is immense. It spans mathematics, computer engineering, governance, and user behavior. But the very fact that this planning is happening today shows the foundational resilience of the network.
Okay, we've established the threats and the complexities of adaptation. Let's move into our final section, which focuses on providing a clear, grounded strategy for navigating this investment paradigm without succumbing to fear. The phrase Q-Day, the day a cryptographically relevant quantum computer comes online, often triggers fear, uncertainty, and doubt in the markets. We need to ground this fear in realistic timelines based on the research we've reviewed. What's the consensus on timing?
Timing is everything, and it has to drive our sense of urgency. While the mathematical threat is certain, experts like Amit Mehra suggest the quantum risk is still years away. It's not likely to become a meaningful threat until the early 2030s.
So the challenge today is matching our agency to the actual threat profile, not the sensationalized fear.
Exactly. And this leads us back to that crucial distinction we raised earlier. The difference between the harvest now, decrypt later threat for encryption and the threat for signatures. Why doesn't that risk apply equally to Bitcoin's digital signatures? This point causes a lot of panic, and it really needs full clarification.
Okay, let's break it down.
This is arguably the single most important distinction for a Bitcoin holder to understand. Harvest now, decrypt later applies to encryption because if an adversary collects an encrypted email today, they can decrypt it tomorrow if they break the key. That encrypted data remains valuable years later.
But Bitcoin transactions aren't encrypted, they're authorized by signatures.
Correct. A digital signature is only used to verify that a message, in this case the transaction request, was authorized at the time of signing. Once that transaction is confirmed and permanently written into the immutable ledger, breaking the signature key years later does not allow the attacker to retroactively rewrite the blockchain or steal the funds that were already spent.
So an attacker who breaks my private key with a quantum computer in 2035 can't change the history of the Bitcoin ledger. They can only forge new signatures going forward from that point.
Precisely. They can only steal the Bitcoin that is currently held at that address. They cannot undo past transactions or rewrite the ledger's history. And because past transactions are immutable, the community has time to plan a deliberate, thoughtful migration to PQC rather than rushing a buggy, potentially catastrophic implementation today.
That clarity allows for intelligent risk management. It gives the community and the engineers crucial time to architect these changes, to handle those dramatically large signature sizes, and to allow the NIST-selected PQC algorithms to fully mature.
Right. They need to understand their performance characteristics and the complex implementation security needed. Rushing deployment, especially with brand new, complex, lattice-based schemes, introduces immediate and present risks like side-channel attacks or implementation bugs that are far more urgent and predictable than the distant quantum computer. Prudence dictates deliberate planning.
Okay, let's pivot to the current market environment. While the technology races forward, analysts at Galaxy Digital suggest that Bitcoin is entering a mature era, which affects how investors perceive risk.
This maturation is characterized by a healthier asset distribution. We've seen long-term holders selling portions of their holdings to new investors, which generally stabilizes the market. It marks a shift away from the pure speculative phase.
Yet investor focus seems to have been temporarily drawn elsewhere by other high-performing sectors.
That's right. There's been a temporary focus on high-growth sectors like AI technology, nuclear energy, quantum tech stocks, and even traditional safe haven assets like gold. And that has temporarily sidelined Bitcoin gains in recent periods.
But the expectation is that attention will return.
Exactly. Analysts expect that this attention will inevitably return to Bitcoin as the asset class continues to prove its long-term viability and its resilience against these very technological challenges we're discussing.
And that maturation is also being quantified in the risk metrics. making Bitcoin potentially more appealing to risk-tolerant institutions.
Yes. Recent market analysis, often cited by firms like JP Morgan, highlights this shift. Bitcoin's volatility relative to gold has dropped significantly. With gold reaching record highs, Bitcoin now presents only about 1.8 times the risk of gold, down from much higher multiples historically. This maturing volatility profile makes Bitcoin a more appealing asset for large, risk-tolerant investors looking to diversify.
Okay, so that's the macro landscape. Now, let's get to the most important part for anyone holding Bitcoin. What actions should a holder take today to defend against the future quantum threat?
The most crucial defense today is excellent digital hygiene, specifically focusing on address migration for any of your exposed keys.
Can you elaborate on the practical steps of that migration process? What should someone actually do?
If you currently hold Bitcoin in an address whose public key has been revealed, which means you have previously spent coins from it, you have an exposed private key that is quantum vulnerable.
So you're at risk.
You are. You need to proactively plan to move those holdings to a new modern address structure, such as SegWit or Taproot, that minimizes public key exposure until the final moment of the spend.
Is the key just to keep the funds in cold storage, or is it more about the address format itself?
It's both. Cold storage minimizes the risk of immediate electronic theft, of course, but the key is the address format. By moving the funds to a brand new, unspent address, you are effectively putting the public key back into hiding. You reduce the time the key is public, and you future-proof those specific holdings against the known quantum vulnerability until the PQC standards are fully integrated into the Bitcoin protocol.
And finally, what about combating that more immediate and pervasive threat of AI-driven manipulation and the generative text oversupply that we discussed?
That requires enhanced cognitive defense. We all need to raise the bar on our critical thinking and our media literacy. The sheer volume of AI-generated fake news sites, which again grew tenfold in a single year, means users have to approach every piece of digital information with extreme scrutiny.
You have to assume it could be false.
You do. Recognize that falsehood spreads 70% more quickly than the truth, and always seek primary sources before making a decision.
So while the network itself needs a technical defense like PQC and secure key management, the user needs a psychological firewall, heightened scrutiny, and the recognition that the digital information environment is now overwhelmingly saturated with low-cost falsehoods.
Exactly. AI is being deployed as a countermeasure for detection and fact-checking, but ultimately, human critical thinking and skepticism remain the essential first line of defense against market and informational manipulation.
This has been an incredibly detailed exploration of a complex triangle: Bitcoin, AI, and quantum. So today we explored how the technological titans of AI and quantum computing present these twin yet distinct challenges to Bitcoin's cryptographic core and its market integrity. We've established that while the quantum threat to key security via Shor's algorithm is mathematically certain, the estimated timeline, likely the early 2030s, provides the community crucial time for a proactive, thoughtful defense.
And that defense is manifesting on multiple fronts. You have global standards, bodies like NIST developing PQC, and you have innovative architectural solutions like Zcash's use of zero-knowledge proofs to obscure the vulnerable public key right now, today.
Meanwhile, AI's power cuts both ways. It drives rapid market destabilization through deepfakes and coordinated bot networks, creating these systemic threats that are too fast for humans or regulators to contain.
But it's also the essential shield. It provides the necessary speed for real-time anomaly detection and optimization for network efficiency.
And the fact that the engineering difficulty of migrating to post-quantum cryptography, dealing with signatures that are 40 to 70 times larger, and the monumental governance challenge of a hard fork is being actively researched and debated today.
Right.
Despite the lack of an immediate threat, it really highlights Bitcoin's foundational technical resilience. They aren't waiting for Q-Day, they're planning for it now. So what does this all mean? The integration of AI and the looming prospect of quantum computing are not just existential threats. They are the most powerful catalysts for necessary adaptation that Bitcoin has ever faced. We are watching a decentralized asset be forced to upgrade its core code and architecture to withstand the computational future.
I think the future of digital assets is less about resisting new technology and more about harnessing the most advanced computational power to build a fundamentally stronger, more secure, and ultimately more permanent decentralized financial system. The challenge is vast, but the opportunity for technological innovation and institutional maturation is even greater. The true measure of Bitcoin's resilience will be its capacity to absorb and adapt to the future of computing.
Absolutely fascinating. We hope you feel well equipped to navigate these complex converging dynamics. Thank you for joining us for this deep dive.